You're listening to the Moneyweb Now podcast series with Simon Brown. Live streamed every weekday at 6:30 a.m.
It's Friday, 21 August. We had Japanese inflation data for July out a few hours ago, 1.9% year on year. I'm Simon Brown, coming at you live and loud from the Moneyweb studios in Gauteng, Johannesburg. On the show today, Skelklo, PSG, Old Oak, strong Spur numbers, and poor Exxaro results been compared to Thungela. But there's T's and C's in Exxaro. We'll dig into that. We're going to chat with Luigi Moronis from PPS Investments. He's talking around the active versus passive, and he's saying in current markets, we might be needing more active than usual. And then thoughts from Ian, US Treasury trying to tame the US bond yields. Good luck with that. This podcast is brought to you by Standard Asset Management. Invest in more global opportunities through their partnership with JP Morgan Asset Management. Morning headlines, Moneyweb, Big Mac price suggests Rand is still too low. Meaningful recovery, however, seems unlikely as local economic factors fuel uncertainty. Business Day, Transnet Ports post record vehicle volumes on surging Asian imports. The facilities of the state-owned transport and logistics company handled the most cars ever. Morning markets, US, red, S&P down 0.9%, Nasdaq off 0.7%. Easter's mixed, we got Sydney up 0.1%, Tokyo down 0.33%, Hong Kong up 0.7% and Tencent down 0.8%. Commodities all green. Gold futures, 4,591. Brent, 93.53. Platinum, 1,879. And palladium, 1,350. The Rand is 16.08. Bitcoin is 74,600. And top 40 opening call, green open, 180 points with 0.18% expected.
Moneyweb Now, on the money. Also available on podcast.
Chatting now with Skelklo, PSG, Old Oak. Skelk, let's kick off with Exxaro. I compared them to the Thungela Resources results earlier in the week. Perhaps not completely. I mean, yes, they've both got coal, but of course Exxaro's got a whole bunch of renewables. They've also got some other minerals in there. And they had a fall in adjusted equity accounted income, which hurt in the numbers quite badly. Your thoughts on the numbers generally, but also the coal sector more broadly?
Hi, good morning, Simon, and good morning to all the listeners. Yeah, it's not a sexy commodity which they are mining. You know, both of them. It's not gold.
Yeah, it's not gold.
Let's just put it. Let's start off with it. So yeah, I thought the numbers were. Yeah, you mentioned it. So sort of flattish when you compare it against Thungela, and we'll get to that part. But still, I mean, revenue rose, 7%, which I thought was okay. Mm-hmm. Yes, the EBITDA was flat, and when you look at the EBITDA, it's pretty much 100% coal. So yeah. they call energy and metals and things, but it's 100% coal. And as mentioned, not too sexy. Yeah, you're right. When you compare the two, it was interesting to note that the one company, namely Thungela, they actually shown an increase in dividends and back to why I would invest in this company. Now, I'm not investing in either of these companies. Mm-hmm. The only reason why I would be investing in this company is for the dividend. Yeah. It's a cash cow. It's something that will give you that income. And when you get a scenario like Exxaro came out and say, well, we are reducing our dividend, from last year, then yeah, suddenly the spotlight will be on the smaller Thungela rather than Exxaro. Yeah, it's a larger company as I mentioned, but I mean when you look at that, their profit margins actually decreased. That's not good, and dividends decrease. So, in short, like I said, not a great set of results, but also not bad at all.
Okay, man, I take it you like the dividend yield. So you like the dividend yield on coal. How about a dividend yield on burgers? Spur. So let's remove the GPS litigation. They've provisioned for it. It's fine. We can park that aside. We've got a dividend yield of 7.6%, return on equity of 22 and change, 500 million of unrestricted cash at year end. I thought South Africans were poor, but man, we are eating at Spur.
Are you taking away my thunder here? I mean, I read the whole phase 3, government and business project yesterday, and then they're talking about getting our economy to grow from the current 1% to next phase 3% and ultimately 5%. And I look at Spur's figures, and I still, I had a conversation with one of your colleagues at Moneyweb last night, and we said, well, I still struggle to find this 1% growth, because when I look at a company like Spur, and I see that the franchised restaurants, I mean, we know that the group turnover was 8.5% growth, but franchise turnovers, that's grown 6.9%. I struggle to find how South Africa is growing by 1%, when let's call it a typical South African company is growing by more than, let's call it 5%. Let's look at the nuggets, chicken nuggets in here. Spur, when you look at the different brands, what I found really interesting was clearly people, still, go to Spur, and they still love their Spur burgers, because that's grown, close to 6%. That's still the biggest part of this let's call it portfolio. But people clearly loved their pizzas more than they love their fish, because Panarotis, that's grown double figures, more than 16%, while John Dory's, they've dropped 11%. So, you took away all. Really cash flow positive. They generated a lot of cash. Your return on equity, close to 23%. I really like the set of numbers. This is really, you mentioned the GPS. That's now sort of out of the way, and they reported it very, very well with and without this impairment, and now the actual, the provision, and now the actual payment. In short, you mentioned the 7% dividend yield. The interim or the final dividend now is going to be R2.06. That's also over 5%. Oh, well, close to 5%. So for all the dividend strippers out there, people that love the dividends, this is a company that can put on the radar for the next few weeks.
And you make the point around the 1%, and I completely hear you, the 1% GDP. Spur's not seeing it. Imagine a 3% GDP, a 5% GDP, what Spur could do then. We would be talking, I don't know, crazy numbers. They're doing really well in what is tough conditions.
That's it. That's the first point. We're just talking about the turnover, but they opened 42 new restaurants. Yeah. They're planning to open another 50 restaurants in the 2027 financial year. That's solid. Let's call it GDP growth. I think excited, and like I said, liked it. Liked it really.
And a great dividend. Leave it there. Skalklo, PSG, O'Rourke, always appreciate the early morning time. Give you money, smoother returns for Stanlib Asset Management. The Stanlib Flexible Income Fund's agile investment process preserves and grows capital in all markets. Is property making a comeback, or are investors walking into another trap? Join Moneyweb Deputy Editor Siren Naidu in conversation with Sifikela Capital and Merchant West Investments as they unpack whether property still deserves a place in your portfolio. Discover where the opportunities lie, the risks to watch, and how interest rates, valuations, and market demand are reshaping property investing. Tuesday, 1 September at the Sandton Convention Centre. Register for free using the promo code MONEYWEB. Visit moneyweb.co.za and secure your seat today.
Moneyweb now, on the money.
Chatting now with Luigi Moronis. He is Head Discretionary Fund Management at PPS Investments. Luigi, appreciate the early morning time. A recent piece you put out, you talk around we've been in a golden age of passive investing. A couple of years ago, passive overtook active mutual funds in the US. The data shows active struggling to beat the index. But you also point out that this really has been helped by that golden age, low rates, practically no inflation, tons of liquidity in the market. And that's not always the case. As things shift, we might need to rethink some of our thinking around passive versus active.
Good morning, Simon. Yes, that is 100% correct. We can't ignore that passive has done particularly well over the last while, and it's been coupled with, of course, passive being relatively cheap compared to active managers as well. And I think the point that we want to make is just that things can change. And so having a combination of passive and active is generally the way that we would advocate for funds to be set up, or solutions in the DFM case. So just be careful, because the expensive stocks are becoming more expensive. And at times, eventually that does turn around. And so the idea is maybe not just to be fully in passive and have some diversified exposure across different asset classes as well.
I get you. I like that. And it is the case of, and I want to come back to what you just said there a moment ago, which is it's a blend of, and we'll park that for now. But in the immediate, yes. I mean, the challenge with passive is that concentration. It's gone up. We know about the tech AI concentration. We forget about the local concentration. 10 stocks, half of the index. And then, of course, valuations. We love those valuations on the way up. We made money from it. But now that gets risky. This is now the risk to that passive because nothing goes up forever.
Exactly. And the thing that drives passive the most is momentum, of course. And momentum is almost defined by the most expensive and the largest stocks getting more expensive. And that works well under certain market conditions, like you just mentioned now, and has been the case over the last few years as well. What I want to say is more if you think of a different way of thinking about it in a way. If you think of, say, value investing versus growth investing, and people have been thinking about that for a long time. We know that value does well for a while and eventually it turns around, and growth does well for a while and eventually it turns around. So that's how we would think about it from an active and passive perspective. The difference, though, with value and growth is generally that active management costs are very similar. And now people are saying, well, the cheap part of the market is doing well, and so why do we even have to worry about the other side of the market? But at the end of the day, at some point, it's likely that we're going to see that turnaround and that kind of normal cyclical way that markets do work. And our point is more just be mindful of that and be careful that may happen at some point.
I absolutely got you. And passive is, and you made the point, you call it, it's a core B2 exposure, and absolutely, and that's what it does. But at times, and this is perhaps one of those times, we need to sort of shift that exposure. And I like your sort of value versus a growth analogy there, the active versus passive. It's not saying, let's move completely out of, but let's shift some of that focus to the active because this is a different market to what we've seen over the last decade.
Yes, we do think so. And I mean, the question is out globally. Around AI, is it a bubble or not? And that's very difficult to predict, we know that. But what is likely is that there's going to be some winners and there's going to be some losers as well. And if you have an active manager that can maybe get some insight into what they believe to be the winners and which ones they believe to be the losers, they might end up with a better outcome than a passive investment that's going to be invested across the board, regardless of whether they think it's going to do well or not. And so there is that value, I think, in the active managers that can use some discretion, especially when things are quite expensive and you're forced to buy those expensive counters. And so kind of taking away a little bit from that could be quite helpful going forward.
Absolutely. And I'm thinking, because again, and we've touched on this, but I think it's bear repeating, is that in many senses, passive chases the hot new thing. And SpaceX, a recent example. And as an active investor, you might look at that valuation of SpaceX and think, whoa, don't know if I want it. As a passive investor, you were buying it regardless.
No, exactly. And that's by definition. And it has worked well for a number of years now, both locally and globally, probably even more so globally. But we have seen kind of, like you said, a lot of the hot counters are getting even hotter. And so, I mean, and that's coupled with a lower fee as well. And so you understand why investors are excited about it and saying this part of the market is definitely the way to go. But I think just some kind of rational thinking around it and seeing what the risks are for that, I think that's an important consideration. Yeah,
and the hotter parts of the market are just getting hotter, and I like that.
And indeed,
and that is the concern, that is the worry. We'll leave it there. That's Luigi Manonis. He is a head discretionary fund management, PPS investments. Appreciate the early morning. And that's our poll today on LinkedIn. Are you preferring perhaps more active over passive in the current environment? Are you shifting your weighting in that regard? Have your vote, have your say. LinkedIn. Let your money weather the storms with Stanlib Asset Management. Invest in the Stanlib Global Select Fund, a diversified all-weather equity portfolio submanaged by JP Morgan Asset Management.
Moneyweb now on the money.
Thoughts from me on the US Treasury trying to essentially tame the US bond market and bond yields. And to be clear, the bond market is typically considered to be the gorilla in the trading room. Equities sit off in the corner. It's all about the bonds and the if you look at the values and the amounts being traded, absolutely the case. It's quite clear that Trump wants the Fed to go full turkey, and not turkey as in Christmas, Turkey as in the country in Europe, and basically cut rates. That's not going to be easy. There are 12 votes on the FOMC. He has maybe 3 or 4. And we also need to be clear that we know what happened when the president of Turkey overruled his central bank, installed, I think it was his uncle or something, cut the rates, and, well, it went badly. The problem the US has is rates are rising. The 30 years trading at levels last seen from the global financial crisis. That is 2008 levels. Add to that, US debt hit $40 trillion on Wednesday. That now costs $1.1 trillion a year just in interest. And it's rising. It's rising because the US has a primary budget deficit. In other words, excluding that $1.1 trillion a year, they are spending more than they receive in tax. Now, easy to solve. Cut the spending, raise the taxes. Neither is happening. So that interest bill is rising. It rises because as they roll the debt, they took out a 10-year bond, or they sold a 10-year bond a decade ago, and maybe they sold it at 2%. And now that bond expires, they roll it, they issue a new 10-year, and they're getting 4.7%. So it's costing more, and they're creating more debt as well because they spend more than they receive. So it is simply going up. So the move by Treasury Secretary Scott Bessent on Wednesday was to say, hang on a second, we're going to double the amount of buying we're doing on the longer dated 10 and 30-year bonds. And in the immediate, it worked. The rates went down. You got buyers in the bond market, and that pushes price up and yield down. So it worked. And what we essentially now have back is quantitative easing, but via the Treasury rather than the Fed. We could argue that QE actually worked last time, but we were, as we were just chatting with our previous guests, in a different space. We were in a low inflation environment. We were in a low interest rate environment, and we were in a high liquidity. So the market saw it for what it was. Governments trying to fiddle and influence markets, but without actually doing what really needs to be done. And again, I'll say it is quite simple. You cut spending and or you raise taxes. In an ideal world, you do a bit of both. So how does this end? Well, it ends in tears. That's just it. You can't fight the market forever. Look, I mean, the US probably can, right? They can carry on printing dollars for certainly, I don't know, the rest of my lifetime. Sure, they can. And in the short term, it will work. But I'm not convinced about the longer term. So what did we see? Weaker dollar, boosted gold, and that's where the trade is as the US fiddles over its 125% debt to GDP burden. The world is worried about our 70 plus, and I appreciate we're an EM over a DM. But 125% debt, bond yields at 30-year high or 20-year highs. The trade here is simple: long gold, short rand. That's it for today. We're chatting with Tertia Jacobs from Investec yesterday. We're talking about the July inflation print, lower than expected at 4.3%. She made a really good point, I thought, in that interview, where she said it's not so much necessarily that inflation is sort of going one direction. We're going to see volatile inflation. We've got that September fuel price increase coming, and looking at Brent prices, it's going to be nasty. It's not so much about less volatility, but she did say that maybe the peak will be lower. We asked you if the worst of inflation is behind us. 2/3 said no, still plenty of risk. The rest was split between it looks like it, and of course your rate is way higher. That is always the case. Have your vote, have your say. LinkedIn. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. We're live every weekday morning, the Moneyweb website and the app, 6:30 a.m., podcast just after 7. Thanks to my team, Eddie Nobokle, Nicole Sabu, to you for listening, my guests for their time. My name is Simon Brown. This is Moneyweb Now. If you're loving the show, please leave us a positive rating in your podcatcher of choice, and we will chat again Monday.
You've been listening to another Moneyweb Now podcast, posted every weekday at 7 a.m. on moneyweb.co.za. Moneyweb Now, on the money.